All right, yes, we are live. Hello, everyone, and good afternoon. Um, Welcome to today's Wednesday live session. Um, Please reach out to people in your cohorts, in your groups, tell them that we are live. Unfortunately, today we will not be able to go live on Instagram because a very important component of our device that enables us to go live on Instagram is missing at the moment, and but we'll be rectify that by tomorrow. But happy to be here again after being away on Thursday. Yes, there was no live on Thursday, and as you all know, it was because of the birth of my child. Right. Thank you so much for all your well wishes. Thank you so much for reaching out. I truly appreciate you all. All right, so quickly, we're going to look at something today, being a Wednesday, um, as we resume work fully. Right? Yes, we're back to work. We're back to work full time. All right. So thank you very much, Madam Mozasike. Thank you so much, man. All right, so today going to be looking at cash flow versus capital appreciation, right? So, which should we focus on? Should we focus on cash flow, or should we focus on capital appreciation? That's what I want us to look at today. You know, one of the biggest mistakes that investors make is trying to box themselves, into this question. That's one of the biggest mistakes that investors make. He's always trying to. Sorry. He's always trying to. He's believing that they must choose either. Some people think that they must always choose one against the other, right? That they must choose between cash flow or capital appreciation. Um, but in reality, the truth is that both of them are important. They are both important, right? The real question that we should be asking ourselves when the issue of cash flow and capital appreciation comes to us is, at the current stage you are in life, right? At your current stage of wealth building, which should receive more attention? At the stage where you are in life, should you pay more attention to cash flow or to capital appreciation or to both? Right? Cash flow helps you to create financial freedom. Capital appreciation creates wealth for you. Now, when you understand the difference, it can completely change how you invest. It can change how you invest. It can determine how you focus on your investments. All right? So, let's even start by explaining what cash flow is. So, cash flow is money that an asset pays you regularly. So, let's say you have um, um, let's say a building, right? And that building you get rent from it regularly. That's cash flow, right? So it could be rent from a property, it could be dividend from a stock, it could be profits from a business, it could be royalties, it could even be interests that you get. So cash flow is answering the vital question: how much money is this asset putting in my pocket? So cash flow is answering that question. All right. So imagine that you own a property that is worth 50 million, and then every month you get 300,000. That's the cash flow. The property is producing a cash flow of 300,000. Right. Similarly, let's say you have a stock worth 2 million, right? But then you get dividend annually as 10,000. Your cash flow is 10,000. Yes, I see you. Good afternoon, ma'am, and TikTok Academy, and everybody who is joining us right now. Right? So, on the other hand, what's capital appreciation? Capital appreciation is the increase in an asset value over time. Right? It's the increase in an asset value. You buy land today for 5 million. 10 years later, it's now worth 30 million. It has appreciated. That's capital appreciation. Right? Um, that 25%, that 25 million naira increase is your capital appreciation. Or you buy shares today at 20 naira. Years later, the shares is now worth 100 naira. Right? Remember, in stock market we call it capital gain, but it's the same thing, right? It's the same thing. It's still capital appreciation. Capital appreciation and capital gain are both the same thing, right? So capital gain or capital appreciation answers the question of how much richer am I becoming, right? How much richer am I becoming? Now, there's a difference, and I want you to think of it in this way. That's between cash flow and capital appreciation. Think of it as cash flow is like harvesting fruits from a tree, right? Capital appreciation is the tree becoming bigger and more valuable, right? Cash flow is getting fruit from the tree. Capital appreciation is the tree becoming bigger, bigger and bigger and bigger. The key is becoming so bigger that it's now worth a lot more, that it can give you more, right? So one gives you income today, the other increases your wealth tomorrow. The cash flow is giving you income today. The fact that the tree is becoming bigger and bigger is increasing your wealth value on the long run. All right? But the both of them matter a lot. They matter a lot. Now, cash flow is what eventually becomes, or what eventually helps you to create financial freedom. Because a lot of people don't understand it, because all their wealth are tied up in areas that do not produce income for them. For example, let's say you own a land that is worth 200 million right now, and you have another beautiful house that is worth 150 million. But yet you're struggling with monthly expenses. Why? Because that land is not yielding anything from you. The house you probably live in it is yielding nothing from you, right? So in all, you have assets that are worth about 350 million, right? But you don't have cash. You're asset rich, but you're cash poor. Why? Because those assets are not generating anything for you, right? So cash flow solves a lot of problems for you. Cash flow buys you freedom, because when assets generate income for you, you get to pay your bills. You can seize up opportunities to invest in other things. You can even increase the investment in the area where you're investing already, right? And that's why Robert Kiyosaki repeatedly emphasizes on cash flow. And in case you've not started reading the Cash Flow Quadrant, that's one book that you must read, right? Robert Kiyosaki tried to let us know that cash flow is important. Cash flow creates freedom, right? And that what makes you ultimately wealthy is that your assets generate enough cash flow that can exceed all your expenses. Yeah, Madam Tony George, I say you're a good money man, right? So at this point, Kiyosaki wanted to prove that in as much as it's important for you to have good assets, but those good assets should be able to also produce good cash flow. It's very important. Now, also on the other hand, it doesn't mean that capital appreciation doesn't matter. Capital appreciation also matters, right? So while cash flow creates a freedom, appreciation is a wealth builder. All right. So I want you to think about prime real estate, shares and companies, successful businesses. You know, the owners of these things became wealthy because the assets multiplied in value. There are people who owned shares. Let's say, as of 4 years ago, the shares was worth 4,000. Then that's in a particular stock. Then 4 years later, it's now 122,000. Some people own buildings, maybe all their building portfolio as of 4 years ago was worth $1 billion. 4 years later, it's now worth more than 20 billion. Yeah, just because the value of the property is increased, right? The value of the property is increased. You know, another thing about capital appreciation, especially when it comes to real estate, is that it also somehow impacts on the cash flow, right? Because the more valuable the properties around a particular area become, the more rent you're likely to pay for those properties or to get from them. All right. So I want us to quickly look at something. I want us to look at some reasons. I want us to look at 1 minute. Okay, so I want us to look at some dangers of focusing only on just one of these things, either on just cash flow or just focusing on only capital appreciation. You know, when you're focused, let's start with cash flow. When you're focused with cash flow alone, some people are obsessed with immediate income, right? When you focus your investment on just getting cash flow, you might be carried away by instant gratification. You will start rejecting investment that will produce you that will grow over time. You just start looking for any investment that will not produce cash flow, you just turn it away, turn it down. All right? And it can make you miss a lot of opportunities. Because the truth is, a lot of the most successful companies today paid little or no dividends during their high growth areas. They paid little or no dividends. Like today, we can see Tesla is a typical example. Tesla is in their growth years. And today, Tesla pays no dividend yet. But the time will come when Tesla will start paying dividends. Now, if you're going to focus on only investments that will pay you dividends, that's cash flow, and then you miss out on investment like Tesla and other growth companies, then it means that you're going to miss out on a huge opportunity. On the other hand, too, if you focus only on appreciation, it's equally dangerous as well, right? Because some people accumulate assets that rise in value but produce very little income, right? So you find yourself in a position where you're rich in assets but you're cash poor. And you've said it before. Somebody owns a valuable land, expensive property, substantial asset, but every month the person is struggling with bills, right? So without income producing assets, appreciation also might not be able to create you the freedom that you want. So what do we do? What you do is we pursue the both. We're not pursuing just capital appreciation alone. We're not pursuing cash flow alone. We pursue both cash flow and capital appreciation. We generate cash flow and we go after appreciation over time, right? How do we go after the cash flow? Typical examples of cash flow: rental properties, business is a cash flow, dividend stocks are cash flows, right? Now, and we also go after assets that appreciate over time, right? That we're talking about land, we're talking about businesses as well, growth stocks. So it helps you create a balance. So what we're saying is, don't tell yourself that all you need to do is focus on one aspect. Focus on, let's say you want to get into the stock market. You tell yourself the only thing you're going to focus on is stocks that will give you dividend. So we're saying you should buy both the dividend stocks and the growth stock. Have a mix of both. We're saying don't just focus on buying properties for the sake of rent. As you're buying properties, look out for lands that have potentials to grow and make you something good along the line, right? And like I said earlier, let's think about it as a tree. A tree. Now, the tree would produce fruits every season, but at the same time, the tree is maturing, it's getting bigger, it's becoming more valuable than it used to be, more and more valuable, right? So that's one way that we should look at it. And another way we should also look at it is to understand that different stages of life require different emphasis on either cash flow or capital appreciation. If you're a young investor, right, a young investor would benefit from focusing more on growth and appreciation. Why? because they have time for compounding to work for them. Somebody who is a mid-career investor would have a mix of both. A retiree will place more emphasis on cash flow because they didn't come to supply their lifestyle. And that's the reason why we say, start now while it's early, grow, let it appreciate. Even as you're getting income from any investment that you have now, be it real estate, be it stocks, right? You're not expected to see that investment as an option for cash flow yet. Why? Because your focus for now should be growth. So it means anything that comes out of it should go back to help it grow. Why? So that when you get to that stage where you retire, you have enough cash flow from your assets to cater for your expenses. Right? You have enough cash flow. Because if you decide that at a younger age, as a young investor, that you want to focus on cash flow, it means that you're not going to build your portfolio enough for your portfolio to be able to take over your job from you by the time you retire. All right? And that is one way that we can look at it. So it's very important that we begin to say it, excuse me, in this light. All right? Very, very important. So the better question is not cash flow or capital appreciation. It's what role does this investment play in my overall wealth building strategy? So the question again is, do you have a wealth building strategy? What is your strategy? Whenever I teach the stock class, one of the things that I teach first is you adapting a strategy for yourself, right? You need to adapt a strategy. You need a strategy. If you don't have a strategy, it means you have no plan. You're going to move in. Every route could seem like that. If they say, oh, we're investing in blue chip stocks, you jump in. If they say, what they're investing in this type of stock, you jump in. Any type of stock is the stock for you, right? So far, everybody's talking about it. But if you have a strategy, then you know what you're after. Let's say you have a strategy, then you tell yourself, my strategy now is growth. Then you know the kind of stocks that you should be going after. Then you know that, if some kind of stock is making buzz all over town, you're not going to look at it because it doesn't answer the question for you at the particular stage where you are currently in life. Right? So that's what we need to do. Yes, starting early can really not be overemphasized. It can't. It can't. It can't be overemphasized. Right? So we need to start early. And if you must grow to the point where, at retirement you have enough, starting early is key. Very, very important. Very, very important, right? So cash flow, capital appreciation, they're not enemies, right? They are partners, right? Cash flow pays for your lifestyle, capital appreciation builds your future. But the question is, or what I'm going to tell you is, don't be in a hurry for cash flow to pay for your lifestyle yet. Don't be in a hurry, all right? Somebody once told me that, now they understand why their investments have not been growing. Why? Because they've been investing in mutual funds, but every year they take away the proceeds. It means it won't grow. Why? Because the person's focus is on cash flow, forgetting that they need to build. Right? Forgetting that they need to build. What I'm trying to say is, as you plant the tree, let me use the tree analogy I used earlier. As you plant the tree, and the tree is producing fruits, right? Don't eat all the fruits. In fact, eat only a few. If not, eat nothing at all. If you can, then if you have other source of income, take the fruits, plant more trees. That's what I say. As the tree is maturing, producing fruits, you're taking the fruits to plant more trees. Why? So that you get to a point where you have a lot of trees that can produce you a lot of fruits that can solve all your problems. But if you have just one tree, and that one tree, you're taking from it, and you just keep taking from it, By the time you actually need to depend on that tree for survival, you realize that that tree cannot cater for your expenses. It's not enough to cater for your expenses. But it remained like that because you did not let it grow. So you need to let your trees grow, right? So as the tree is yielding fruit and is growing in appreciation, you're planting more trees. So you have more trees that are producing fruits and also growing, becoming more mature, becoming more valuable. That's what the wealth building process is about. That's what it's about when you're combining both cash flow and appreciation. So you get to a point where you have a lot of trees that are worth a lot, but at the same time, still producing a lot of fruits. So you have plenty fruits that you have more than what you need, right? You have more than what you need. So that is the goal. That's the goal for our investing, especially when any investment at all. It mustn't be stocks, both real estate, any investment at all. The goal for now is to keep growing. Yes, of course, unless you've gotten to that point where um, you're about to retire, then you need to focus more now on generating a lot. In fact, you need to focus more. You won't just plant one tree and wait for it to fruit before you plant others. You plant multiple trees at a time, if you understand what I mean. If you're close to retirement age, then you need to start planting multiple trees at a time. You need to aggressively plant a lot of trees, right? But if you have time, and that's why starting early is important. Now, look at the stress it will take you, right, to plant a lot of trees at a time. But if you have the time, if you start early, you can plant one. And from that one, you can take and plant more as it produces fruits. Right? Yes, thank you so much, Madam Linda from Ireland. Okay. Madam Linda said, I got coupons from bonds, but it's not encouraging. Would you advise to keep at it? Yes, keep at it. Remember, it's not your only strategy, right? The bonds in your portfolio is there as some form of diversification. It's not there as only the means whereby you are investing, right? I'm sure you have other other areas where you're also investing your money, not just in the bonds. So keep at it, right? But look for better options. But even before now, you should know how much you were expecting, how much coupons you were expecting even before now. Because before you get into the bond agreement, you already know that this is this percentage that you're getting as coupons before it comes, right? So keep at it. Don't be discouraged, right? Put it right back. If you find better options, you can go for it. If you can put in more money, then that would also make it make better sense. But always remember that bonds are always part of your portfolio as a means of diversification, just so that, just say you don't have all your eggs in one basket, right? So that's just what it's there for. Remember, it's one of the secure ways of investing, especially when you're investing in government-based bonds, right? It's a very secure way of investing, and you stand a very low chance of getting into trouble when you invest in government-based bonds, right? Because they are always sure to pay. They might not pay you that much, but they're sure to pay, and it's a good way to diversify your portfolio. Yes, thank you so much. Thank you. Thank you once more. Thank you so much, everyone, for being here. Today is not a long day. We're getting into the grind gradually. By tomorrow, we'll spend more time here tomorrow. But this is where we're going to end it today. So there's one thing I'm going to leave you with today. The goal for now is growing in value while also producing income, right? Growing in value while also producing income, right? So we're growing, producing income, we're putting it back, and we'll just keep growing, all right? So thank you very much, everyone, for being here. We're going to be back again tomorrow. Yes, we're getting back into the full flow of work. So tomorrow, we're going to be back here. I just resumed work today anyway, since my wife put to bed, and it's been an amazing journey. I'm very glad. I'm very glad for the birth of this child, and for the miracle of her, because it was quite an experience, but we are happy nonetheless, and we're grateful to God for where we are, right? Very grateful for God for where we are. A lot of people have been asking me, so the next baby, there will be no next baby. This is our last. We are done. We are done, and we are glad. So thank you very much, everybody, for being here. My name is Chukwuemeka Oyedezi, and I'll see you again tomorrow. All right. Please remember, we're going to be back here again 2 p.m. 12 noon. 12 noon West African time. That's when we're going to be back tomorrow. 12 noon, we're going to be back here again. All right. Thank you, and thank you, and thank you. Mr. Chris, thank you so much, sir. I see you, sir. Thank you so much. Those in Enugu, I hope you're expecting us by the end of the month. TIP Summit Enugu, we're not missing that for anything, right? In fact, the rest of the TIP summits, you're sure I'm going to be there. I wasn't to the TIP summit in Port Harcourt because my wife was highly expectant during that period, so I couldn't make it, right? But rest assured, every other place that is not visa constrained, I'm going to be there. Thank you so much, everyone. See you tomorrow. Bye-bye.